Picture two brothers-in-law at a family barbecue in the summer of 2024. Same age, same city, same net worth, same everything except one conversation that's been running between them for 3 years now about what to actually do with money once you have some. Tony is convinced that real estate is the only real path to wealth. He'll tell you why with the confidence of someone who has already decided. Tenants pay your mortgage. Property always appreciates. You get tax benefits stocks can't touch. You can see it, touch it, drive past it. It's real in a way that a number on a brokerage screen simply isn't. Kevin thinks Tony is building a second job and calling it an investment. He puts everything into a diversified index fund, contributes automatically every month, and genuinely does not think about it the rest of the time. He has nothing impressive to say at the barbecue. No tenant stories, no property tours, no depreciation schedule to explain. He has a username and a password and a number that goes up over time. They have the same $70,000 saved. They both earn $72,000 a year. This is the story of what happens to both of them over the next 20 years. Told honestly, with real numbers, including every cost both sides conveniently forget to mention. My name is COLT, and in this video we're running the full unfiltered math on real estate versus index fund investing, year by year, dollar by dollar, including everything that never makes it onto the YouTube thumbnail or the real estate meetup slide deck. If you've been told one of these always wins, stick around because the honest answer is more nuanced and more useful than either camp admits. Subscribe and hit that like button if you want the full picture instead of just the version that makes one side sound obvious. Tony puts his $70,000 into a 20% down payment on a $350,000 duplex. He lives in one unit and rents out the other, a strategy called house hacking that immediately reduces his own housing costs. His mortgage on the duplex is $2,210 per month at current rates. His tenant pays $1,400 per month. His effective housing cost drops to $810 per month, significantly below what he was previously paying in rent. On day one, Tony has made a genuinely smart financial move that index funds simply cannot replicate. He has reduced his largest monthly expense, built in a paying occupant, and taken control of an asset worth 5 times his original investment using the bank's capital. Tony is legitimately winning at this point, and he knows it. Kevin takes his $70,000 and splits it into a Roth IRA and a taxable brokerage account, both invested in a total market index fund. He sets up a $400 monthly automatic contribution and goes back to his regular life. He has no story to tell. He has no asset to show anyone. His coworkers have already changed the subject. Year one for Tony is genuinely excellent. He's reduced his monthly housing cost dramatically. His tenant is reliable and pays on time. He's claiming depreciation on his taxes, which meaningfully reduces his taxable income. His property is appreciating. He has a monthly surplus he didn't have before because his housing is now partially subsidized. If you froze the story here, Tony would be the obvious winner by a significant margin. Year one for Kevin is completely invisible. His $70,000 has grown to maybe $77,000. He contributed $4,800 over the year. Nothing about this feels meaningful yet. If you ask Kevin how his investments are going, he'd say fine and mean it and move on. There's no drama here because there's no story here yet. The story is happening so slowly that nobody can see it, including Kevin. Let's run year 3 honestly. Tony's property has appreciated to roughly $385,000 to $395,000. His tenant has renewed twice, which is good. His equity, what the property is worth, minus what he owes, is growing steadily. But here's what's also true by year 3. The unit he rents out needed a full bathroom renovation after a pipe froze and cracked inside the wall during an unusually cold February. That was $4,800. His roof had a section that a home inspector friend told him wasn't going to last another full winter, so he addressed it proactively for $3,200, rather than wait for an emergency. His tenant's lease renewal came with a request to repaint and replace the kitchen appliances, a negotiation Tony handled himself across 4 separate evenings that he will never get back. His total real maintenance and improvement spend in 3 years sits at approximately $11,000 above routine costs. His actual cash position after all of this, after the genuine running costs of owning a duplex are calculated honestly, is slightly positive but nowhere near the financial freedom narrative he tells at family gatherings. Kevin's portfolio, by the same point, sits at approximately $105,000 to $112,000, including $14,400 in contributions over 3 years. He experienced one market correction in year 2 that briefly took his balance down to $87,000, which he found genuinely uncomfortable to look at and genuinely didn't sell through, which was the right decision and harder than it sounds. The recovery happened. The number kept climbing. He did nothing except continue the automatic contribution. Here's the thing that nobody says clearly when comparing these two investments. They are not actually the same type of decision dressed up differently. They are fundamentally different relationships with capital, time, risk, and attention, and understanding the real difference between them changes how you evaluate both. Real estate is an operating business wearing the costume of a passive investment. It requires decisions, attention, judgment, relationships with contractors, understanding of local law, knowledge of landlord-tenant regulations, and tolerance for the specific kind of stress that comes from another human being's housing situation being your financial responsibility. None of this is bad. Plenty of people are genuinely suited to it and build extraordinary wealth through it. But it is not passive. It has never been passive. And the return figures thrown around in real estate conversations almost universally omit the hourly cost of running the business you didn't realize you were buying. Index fund investing is genuinely passive in a way real estate is not. It is also genuinely boring in a way real estate is not. The behavioral risk of index fund investing isn't maintenance costs or bad tenants. It's the investor's own psychology during market downturns. The single most common way people destroy index fund returns is by selling during corrections and buying back in after the recovery, which locks in losses at exactly the wrong moment. If Kevin can hold through the down periods without panicking, his returns are largely determined by the broad economy's long-term growth trajectory. If he can't, his actual returns may be significantly lower than the headline numbers suggest. By year 5, Tony has made a decision that materially changes his story. His tenant in the rental unit has moved out, and Tony has decided not to replace them immediately. He's going to use the unit for visiting family for a few months and then relist. That gap costs him 7 months of rental income, roughly $9,800, while his mortgage continues without interruption. This is not a financial disaster, but it is a real cost that his original financial model didn't include because it couldn't include it. Life doesn't follow models. People move. Plans change. The flexibility that makes real estate feel controllable is also the flexibility that allows the unexpected to cost you in ways a stock portfolio simply cannot. Kevin at year 5 has a portfolio sitting somewhere around $150,000 to $165,000. He's been through 2 market disruptions now. He held both times. The compounding is beginning to accelerate slightly. The gains are starting to generate gains that are themselves meaningful rather than trivial. The curve is bending upward. He still has nothing impressive to say about it. Let's talk about the costs that live beneath every real estate return number, the ones that make the actual after-expense return look different from the dinner party version. Property taxes are not optional and they increase. In most markets, property taxes on a $350,000 property run $3,500 to $7,000 annually depending on location, and they tend to increase as assessed values increase. Over 20 years, this is a 6-figure cost that receives almost no attention in return calculations. Insurance has become a genuinely significant expense in the current environment. Landlord insurance policies have increased dramatically in many markets due to climate-related risk repricing. Costs that were $1,500 annually 5 years ago are $2,800 to $3,500 annually in many regions today, and the trajectory is not improving. Capital expenditures are the silent bankruptcy of amateur landlords. Every major system in a house has a lifespan and a replacement cost. HVAC systems run $6,000 to $12,000 to replace. Roofs run $8,000 to $18,000. Water heaters run $1,200 to $2,500. Electrical panel upgrades when required can run $3,000 to $7,000. These costs are guaranteed over a 20-year horizon. They are not if questions, they are when questions. Landlords who don't reserve for them monthly aren't running a business. They're spending future emergency money they haven't saved yet. Vacancy is not a risk to plan for. It's a cost to budget for. Even excellent landlords in excellent markets experience turnover. Every tenant transition brings cleaning, minor repairs, listing costs, and screening time. The industry standard is to budget for 1 month of vacancy per year. Over 20 years, that's 20 months of mortgage payments with no offsetting rental income. None of these numbers appear on the napkin calculation. All of them appear eventually in the bank account. Year 10. This is where the comparison becomes genuinely interesting. Tony's duplex is now worth somewhere between $470,000 and $500,000. His mortgage balance has dropped to approximately $225,000. His equity position is roughly $245,000 to $275,000. This is real, significant wealth built partly through leverage and partly through his tenant subsidizing his mortgage for nearly a decade. His total net cash position from rental income after all genuine expenses over 10 years is somewhere between $15,000 and $35,000. Far less than the gross numbers suggested, but the equity story is genuinely compelling. Tony has built $250,000 in equity on a $70,000 investment over 10 years. That is a real return, and leverage deserves real credit for it. Kevin's portfolio at year 10, with $400 monthly contributions continuing throughout and approximately 10% average annual return, sits at roughly $210,000 to $235,000. His total contribution over 10 years was $70,000 upfront, plus $48,000 in monthly contributions, $118,000 total invested. The remaining $92,000 to $117,000 is pure compounding. He spent no hours managing it. He took on no debt. He has no concentration risk in a single property in a single neighborhood. At year 10, Tony holds a meaningful advantage in total wealth, and it is almost entirely explained by leverage. He used the bank's money to control an asset 5 times his original investment, and that mathematical multiplier is the genuine superpower of real estate that honest stock market advocates don't dismiss lightly enough. But here's what else is true at year 10. Tony cannot access his wealth without selling a property, which takes months, involves transaction costs of 6 to 8% of the sale price, and triggers capital gains taxes. Kevin can access his wealth within 3 business days at current market value with no transaction costs and favorable long-term capital gains tax treatment. Tony's entire net worth is concentrated in one asset in one neighborhood. Kevin is diversified across thousands of companies in dozens of countries and sectors. Tony's return required hundreds of hours of active management. Kevin's required essentially none. These are not small differences. They are fundamental differences in the nature of the wealth each person has built, and they matter enormously depending on what happens in each person's life between year 10 and year 20. Year 20 is where the compounding story fully reveals itself. Tony's duplex is now worth somewhere between $620,000 and $700,000. His mortgage is either paid off or within a few years of completion. His equity position is between $550,000 and $650,000, assuming reasonable local appreciation. He has collected rent for 20 years, managed 2 full tenant cycles in each unit, navigated 2 significant repair periods, and accumulated what is genuinely substantial real estate wealth. His total net cash profit from operations after every real expense over 20 years might be $60,000 to $120,000. More in a hot market, less in a flat one. and it required active participation for essentially the entire 20-year period. Kevin's portfolio at 10% average annual return, with $400 monthly contributions over 20 years, has grown to approximately $560,000 to $620,000 from his $70,000 starting investment, plus $96,000 in contributions over the period. His total invested capital was $166,000. The remaining $394,000 to $454,000 is compound growth on compound growth, the mathematical miracle of leaving money alone long enough for it to genuinely multiply. He did not manage anything. He did not negotiate anything. He did not replace anything. He did not evict anyone, screen anyone, or spend a single weekend coordinating contractors. At year 20, their total wealth positions are genuinely comparable, both somewhere in the $550,000 to $650,000 range in their primary investment vehicle. But the paths could not be more different in what they demanded from each person, and the paths matter as much as the destination when you're 20 years older, and your energy and tolerance for complexity are not what they were at the barbecue where this all started. Here's what happens if Kevin makes one adjustment at any point during this 20-year period. If he increases his monthly contribution from $400 to $600, his portfolio doesn't grow proportionally. It grows to approximately $720,000 to $800,000 at year 20. That's because compounding multiplies contribution increases in a way that real estate's linear equity building cannot match without purchasing additional properties, taking on additional mortgage debt, and doubling the management obligations. The scalability of index fund investing is genuinely different from the scalability of real estate, and that difference becomes the dominant factor in building wealth beyond a single property or a single portfolio. Real estate has advantages that deserve honest acknowledgement. Leverage on an appreciating asset is genuinely powerful and genuinely unavailable in standard stock market investing, without unacceptable margin risk. The tax treatment of depreciation is a legal shelter with no equivalent in brokerage accounts. House hacking specifically is one of the most financially efficient strategies available to anyone who is willing to share a property, because it attacks your largest expense and builds wealth simultaneously. And for disciplined operators who treat it as the business it actually is, with proper capital expenditure reserves, careful tenant screening, and realistic expense modeling, the returns can meaningfully exceed what a purely passive index fund strategy produces. Index fund investing has advantages that deserve equal honesty. It is genuinely passive in a way real estate never is. It is liquid in a way real estate never is. It is diversified across thousands of assets in a way a single property investment fundamentally cannot be. The behavioral risk is real and significant, but it is the only risk you manage, and it can be managed through automation and deliberate not touching of the account during downturns. Tony and Kevin are still arguing about this at the barbecue, 20 years later, with roughly similar net worths and completely different stories about how they got there. Tony worked for his. Kevin waited for his. Both of them are better off than the brother-in-law who spent 20 years intending to do one or the other and never started either. That last sentence is the actual point. The debate between real estate and index funds is a real debate with real merit on both sides and no universal correct answer. The debate between starting and not starting has a universal correct answer, and it isn't the one most people are currently choosing. My name is COLT, and if this changed how you think about either of these investments, subscribe, because we run this kind of real math every single week. Hit the like button if you've been given a confident answer to this question without anyone ever showing you the full numbers. And if you know someone currently paralyzed by this exact choice, send them this video before the paralysis costs them another year of compounding they'll never get back.